which we can we go ahead and use that in our social media to advocate the skilling financing?
Yes, absolutely. So, Brian, you'll be sharing the link to the recording after the
Yes,
webinar? Yeah.
absolutely. And that's the same way what we do in Opportunity International. We normally share this, and also the link will be available on YouTube as well.
Great, great.
Sakshi, back to you.
Start. Good morning, good afternoon, and good evening, depending on where you're joining from. Welcome to our session, Financing Skills for Livelihoods. I'm Sakshi Sodi, and I'm co-moderating today with my colleague Rebecca. We both work as technical assistance advisors in India and Kenya, respectively. Rebecca,
Buenos
why
días,
don't you say a quick
trabajamos.
hi?
Hi
Rebeca,
everyone. Good
¿podrías
morning. Good
saludar?
afternoon. It's a pleasure to be here. My name is Rebecca. I am
Es
the
un gusto
country
estar
manager.
acá. Soy Rebeca.
Let me get back to you, Sakshi.
Soy
On this call, we have financial institutions, training
encargada. En
providers,
esta llamada
government
tenemos
agencies,
instituciones
development
financieras,
partners, and
proveedores de
investors from across
entrenamiento, agencias de
Africa and
gobierno,
South Asia.
socios de desarrollo
That
e
makes this
inversores
deliberate.
de África
The
y
conversation
de
we need to
el
have
sur
is
de Asia. Esto
exactly
nos
where those
hace
worlds meet.
empezar
Let me
esta
hand over to
conversación.
the
Ahí es
director of this
exactamente
show,
donde se
Brian,
encuentran
to
esos
tell us
mundos.
about
Voy
the
a cederle
audience,
la palabra al
panelists, and
director
set the
del
ground for
show,
today's session.
Brian, para contarnos sobre los panelistas y para establecer y preparar el terreno para la sesión de hoy.
All right, thank you so much. Sorry
Bueno,
for the
muchas gracias.
interpretations. I'll set that after 5 minutes when we get together. But in the meanwhile, let me take you through to the housekeeping. So as you've heard the voices behind the scene, those are the interpretation will be live in just few minutes. I'll take care of that. And also, so they will be available in Spanish and French as well. So feel free to switch into any language of your convenience. We'll post on the chat on how to do that in a minute. But also this call will be recorded just for sharing the learnings. So we'll share this after the session ended, but also will be available in our social platform, including YouTube as well. And also in the meantime, from now until the session ended, please feel free to use the chat box if you have any question or struggling with anything, and we'll be able to respond accordingly. Right, so let's get to see who is in the room. So we've got to join with a very excellent panel. And to beginning with, we have Sharat, Mr. Sharat. He's a co-founder and chief business officer at FIMOC from India. We are very happy to have him on board. He has been serving that position since 2021, and he gonna share a lot of learnings today. We also got to join with Mr. Shamvis. Sorry if I pronounced that wrong, but he is an executive vice president from National Skills Development Corporation based in India, from India. And he also going to help to share a lot of contribution, and we are going to learn a lot from him as well. We also blessed to have Madam Janet Kuteli. She is a founder and CEO at Fortune Credit Limited in Kenya. Lovely to see you joining us today. And also going from Kenya, we also got joined with Hercules Omondi. He is a credit officer from High Education Loans Board from Kenya. So he is also going to share a lot of contribution from his end, and we're going to learn a lot from him. Thank you so much for joining us. Last but not least, we have Mr. Prashant. He is a founder and a CEO at Tucoms Group in India. They have received a number of awards, recognition globally, but we also have more than 700 plus active clients. So we're going to also benefit a lot from his contribution. Thank you a lot for joining us today. With that, let me bring back the mic to Sakshi. Thank you so much. With my own introduction, I'm Brian Amaniteri, and I am Community Events and Learning Associate based in Dar es Salaam, Tanzania. Back to you, Sakshi.
Thanks, Brian. Let us now hear from our Director of EduFinance, Jay Naik.
Thank you very much, Sakshi. Hello, everybody. Good morning, good afternoon, and good evening from wherever you have dialed in from. We're happy to have you today. I want to add my voice to my colleagues to welcome you to this webinar. Now, for many years, success in education was measured by one key metric, and that is enrollment. So basically getting children and young people into school was rightly a global priority. However, as we have seen, as time progresses, enrollment is only just a beginning. So basically we see it as an input. But what is the ultimate outcome of that input? So today, what we are looking at is that what does education actually lead to? We have far too many young people. And this, if you look at, for example, Sub-Saharan Africa and across India as well as other countries, these many people still want answers. But the questions they keep on asking is, yes, we've gone through education, but the answer is still, you've not yet got a job, not yet an income, and the livelihood is not sustainable. Okay. So now, while education attainment has increased, the pathways from learning to employment and entrepreneurship have not kept that pace. If you are from Uganda, for example, where I'm calling in from today, you'll see that we have so many things like free universal education, free secondary education. So people have gone through that education, but ultimately, how are the jobs coming through? I want us to focus a little bit on what Opportunity International has done over the years. Through 226 financial institution partners across 32 countries, together with our partners, we've mobilized greater than 1.4 billion US dollars, and more than 950,000 loans have been granted. Now, when you look at the results of that, and you look at the portfolios, we see that we have an achievement of 96% repayment rate on tertiary education, 94.2 on tertiary education, and then school fee is 96, but then on the school improvement loan is 96.2. So those are really, really good repayment rates. So now sometimes when somebody tells you that education finance is risky, for us as practitioners, we should be able to ask them, which portfolio are you really looking at? Because when you look at those metrics, they really show that those are very good repayment metrics. So what we have learned over the years is that education lending is not inherently risky. Sometimes it's the perception that we have about this product. Now, the real challenge is not a lack of demand. When you see how much has been invested in this sector, it's not even a willingness to repay. You've seen the repayment rates. But we've seen that many products are really conventional financial products that most of the times are designed for salary earners. But what about some of the workers that do not have that traditional collateral? When we look at the sector that we are discussing today, this is a sector that runs on intake cycles. It also focuses a lot on people who have informal incomes and delayed employment outcomes. What we realize that this is not a financing gap per se, it's a mismatch between finance and the realities of education and employment. Now, today's webinar is about closing that gap. When you look at that lineup that has been shared with us, you'll realize that the people who are joining us today are not going to discuss theoretical things. We'll hear practical insights from two main markets, and that is from India and from Kenya. And for us who have dialed in from the rest of the world, let us engage them and see what comes out. So I am hoping that this becomes a learning point where we want to see how education finance can better align with the real world pathways to work. Thank you for joining us once again, and I look forward to a rich and engaging discussion. Thank you, and back to you, Sakshi.
Thank you, Jane, for setting the context and opening the session for us. Let us begin our webinar with evidence. Rebecca has just completed a market research study on TVET financing in Kenya. Over to you, Rebecca, to shed some light on the findings.
Thank you very much, Sakshi, and welcome everyone. We now shift into the Kenyan section. This is the heart of the evidence of today's meeting. This is where we are going to talk about 4 findings and 1 contradiction that define TVET financing landscape in Kenya. These findings come directly from institutions, students, employers, and lenders across Kenya. I'll begin with the first finding. The first finding is skills training is expanding. And as you look at skills expanding, we are talking about 650,000 learners, 2,496 institutions in Kenya. We are talking about 22% enrollment rising. We are talking about 134 strong market showing confidence. But these sits inside the labor market, where 83% only are the workers who are informal. The demand is booming, but yet financing has not kept the pace. When I go to the second finding talks about TVET leads to jobs, but not formal jobs, mostly informal jobs. So the good news today is 62% of graduates are working. The reality is 15 are only formal employment. Most graduates earn through informal, seasonal, or self-employment income. So this means repayment schedule cannot assume a salary arriving at the end of the month. Products must be designed for irregular income as well. The next finding, our third finding, talks about a large untapped market. And this is where we've realized the market is real and is measurable. Institutions want $13.15 million financing. This culminates to 30% who are seeking loans right now. Students demand $82 million annually, with a median of $38. Together, all that leads us to 92 million annual market, largely unaddressed. This is hypothetical, but it is it's really concrete, it's quantified, and it is waiting. As we look at the finding number 4, this one talks about the contradiction that we have in our beliefs. It talks about 78% of TVET institutions are profitable, yet only 20% are ever borrowing in this market. These institutions are viable but unfinanced. So where are we headed as Kenya or as the globe? We go to the 5th finding. The 5th finding here tells us that borrowers are good, but products are not good. So what are we going to do about it? This is where we come and say students earn a little with a median of $77 a month. 86% of these students, they depend on parents because formal products don't fit. 68% turn into digital lenders. 68.7% struggle with the repayment, not due to unwillingness to pay, but because the products don't match their income at all. 82% say repaying matters greatly. Borrowers are motivated, products are mismatched. This leads us to another critical finding that we found out from this market research. It led us to agree together that the product design is the problem. And this cuts across 4 structural mismatches that appear again and again. And these were repayment statuses. We talked about collateral requirements, lock out most of the borrowers, fixed monthly payments don't match seasonal earnings, tenures are too short, which leads us, all of us here to agree that the solution is not changing borrowers, it is redesigning this product. And to just emphasize on this more, what I have described as our finding is just a hypothesis of what we found out in this market research. My colleague Sakshi from India, she has been able to run this portfolio for 5 years. She'll be able to share with us the key insights now real that has happened in the past 5 years. Back to you, Sakshi.
Thank you, Rebecca. Any financial institution that has been ever involved in skill financing in India or operates a training institute is likely to be familiar with National Skill Development Corporation, NSDC, and one of the most respected names in the sector, Mr. Sanjeeva Singh. Mr. Singh has not only been a pioneer in introducing skill loan financing in India, but has also played a pivotal role in driving the reforms that have shaped and strengthened the ecosystem. May I now invite Mr. Singh to briefly introduce himself and then walk us through the key reforms that have transformed the skill financing landscape.
Hello, everyone. Good morning, good afternoon, and good evening. I'm Sanjeeva Singh from National Skill Development Corporation, and I will be sharing my experience of a skill loan, how it has moved from scratch to a level today in India. In 2015, Government of India has started a support scheme that is called Credit Guarantee Scheme in India for a skill loan. And post that, even after 6 or 7 years, that number has not scaled up to the point. So if we take the data, so in 6 years, it was only 12 million amount was lent to 10,077 borrowers under the skill loan scheme as on March 24. Reason being that the ticket size of the loan was kept at USD 1,560 maximum, where the all employability courses are more expensive. Apart from that, a different reason was that there were very few lenders, those who were recognized for providing or getting guarantee from those given scheme. And fourth problem was that in India, all skill courses there are recognized by Government of India, and those courses are called NSQF, National Skill Qualification Framework course. So only those recognized courses were guaranteed, being even guaranteed. Just to make the matching of the entire course, some changes were made in 2024. Just I am giving you a few highlights of the changes what was given. So loan amount limit was enhanced from 1,560 USD to 7,800 USD, and guarantee cover was given 75% for up to USD $4,158 and 70% for beyond that amount. And the entire loan was given collateral free. Wider courses were permitted. So from only non-NSQF aligned courses to NSQF aligned courses plus non-NSQF aligned courses, those courses which were on MSDE, that is Ministry of Skill Development and Entrepreneurship, skill portal that is called SIDH portal, were eligible for getting these guarantees. And all these courses were industry aligned courses that was leading to employment of the candidate. Apart from that, the lending institutions to who are eligible for getting guarantee, that was enhanced from only, that was earlier in banking sector, that has been enhanced from banking to NBFCs and microfinances and small bank finances. That led to a growth in the entire lending market. This one reform, how it changed the entire market, that is depicted here. So pre-2024, pre-amendment, the entire loan guarantee was given 10,425 loan accounts. Within within a year, post modification in scheme, it added 4,014 new number, and as on date, the entire number comes to 14,439. Similarly, if we see about the amount, prior to that amendment, In last 6 years, the entire amount was 12.5 million USD, and within a year, it added 6.1 million USD. As on date, it's 18.6 million USD, the entire loan outstanding disbursement. If we talk about lending institutions, prior to that modification, it was only 17, and now it has added more 14 courses. So it has come to 31 entire courses institution in the market, and that has ended into 39% more loans guaranteed in 1 year. Lending institution improved from 17 to 31, and 150,000 loan has been given in the entire period of skill loan in India. Now coming to the next part, wherein what is working and what is not working in India. So what we have seen that positive impact has given a proven scalable B2B2C model. That means here NSTC is connecting with the training partners, and training partners with connecting with the appropriate candidate, and based on this B2B2C model, reaching a student to lower and middle income communities at scale. Apart from that, Catalytic Capital is beginning to arrive. So CSR foundations, sharing credit risk and mobilizing commercial capitals. Institutions are growing, higher enrollment, more courses, better facilities because of the finance existing for all those candidates. What is not figuring out as on date? As on date, still there is no credible uh, rating system is available for all lenders so that they can price their risk. Cost of fund for these NBFC are very high. Reason being, these NBFC are not permitted to accept deposits from public. That is a cheaper cost. Placement risk gets priced at. Reason being, for any skilling, that placement is subject to economy, and there is always a risk of placement. So sector downturn, break placement guarantee, and land in the interest rate. Extreme concentration. Here we see in India that 80% of convertible leads are coming from only 20% of the training institutes. So there is a concentration risk in the market as on date in India. So these are certain learnings from India that can be eye opener or for learning for other areas. Thank you.
Thank you so much, Sanjeeva sir, for your relentless efforts to build the ecosystem the world is now talking about. We can stop sharing the screen now, Bright. Let me now bring in my panel. First, Sharath from FIMONC, a young Indian lender that has financed skill loans for over 16,000 students from underserved backgrounds in just 4 years. Joining him is Prashant from TUCOMS, one of the India's leading skilling organization with over 400,000 learners trained and placed through strong partnerships with employers, government agencies, international recruiters. They represent two sides of the same ecosystem. FIMONC finances learners by assessing not just students, the courses, the training institutions, employability outcomes. TUCOMS creates those outcomes by training talent, connecting with employers, and placing learners in the jobs across India and overseas. Together, they show how finance and employability can work hand in hand to unlock opportunities for thousands of young people. My first question is for you, Sharath. For 9 years, as we see in the statistics which Sanjeeva sir just showed, that India's skills loan scheme barely moved for 9 years. Then the rules changed, lending grew by nearly 40% in a year. The number of participating lenders doubled. Was the real problem ever credit risk, or simply that the risk uh, uh, wasn't ever understandable to the credit committees? And despite the reforms, why do nearly 70% of the skill loan book portfolio still remains outside of the guarantee cover?
Right. So thank you, Sakshi, and hello, everyone. Our experience has been from the past 6 years in this sector, Sakshi, has been the answer to your question lies in multiple areas. One is the number of institutes. As Mr. Sanjeeva rightly pointed out, there is no framework to score an institute saying this is a worthy institute to partner with. We also operate on a B2B2C model. And, a lot of times our risk underwriting starts from the institute. and it is very difficult to find at least a 3-year vintage institute who have proven outcomes. The younger institutes are very passionate, but it's very difficult for us to rely on their potential. So we have to look for outcomes. So this is the first point. And the second point is when they do placement guarantees and the economic downturns or the expectations are misaligned between the candidate and the training partner. These are the two, and why the credit guarantee schemes really did not scale. At least in our experience, we have been a member lending institute, but we could not come forward to use that scheme till date. Was our cost of capital structure did not align with the conditions set by the eligibility of this scheme. I'm not talking about the latest update which came 1 week ago, but until last 1 week ago, that was the case, where the scheme was there in place, but it was not serving the purpose, at least for a lender like us. We are considered a small to medium-sized lender in this sector, and our cost of capital is so high. And if we try to tap this credit guarantee scheme, there is no way our unit economics are feasible. So one is the underwriting of the institutes. Second is the placement being an anchor to the entire ecosystem. And third was the cost of capital. These are the main three reasons why at least we have not been able to rely on this scheme and scale the book till date.
And likely so for many other financial institutions such as yours, Sharath.
Yeah.
Great. Okay, so moving on to my next question for you, Sharath. Our research also says that two things that sit uncomfortably together. There is no rating mechanism, which you just spoke about. So the lender can't tell an excellent institute from a fraudulent one. Yet 80% of the convertible leads are coming from the 20% of the institute. So somebody already knows who the good ones are. How do you underwrite an institute today? And if you build the rating system this sector is missing, what would it measure and who should own it? Is digitization also important for underwriting?
Right. Digitization is definitely important, but who should be underwritten? So I will just quote one example. The banking and financial sector in India is booming. So all the banks are trying to expand by hundreds of branches across India. So they don't have the recruitment muscle to do this level of hiring. So what they're doing is they're tying up with a lot of training partners and giving them a mandate to hire at scale. So this is called a hire, train, and deploy model. So we worked with at least half a dozen players in this. And I'm quoting this example so that everybody understands the difference between a successful model and why others cannot succeed. So if the job at the end of this program, the outcome is a bank teller and the starting salary is say 25K per month, some institutes have been very greedy in providing this outcome, and they price the product at a 3 lakh rupee or a 4 lakh rupees. So the salary itself does not support this outcome. But for a lot of them, the first job is a big breakthrough that will unlock their wedding, that will unlock their family status, so many things. So in the society, so some people afford it, some people cannot. But the successful players have been those who price the program at a very right pace, at 100K as the course fees for getting this trained. The reason is not all jobs are bank teller. A lot of them are sales oriented. And, when you give the sales job as an outcome and when you charge a very hefty fees, the candidate is torn between the pressure that the first job is creating and the monthly payment that the lender is instilling. So this has been the misalignment. So I believe the right underwriting or the right way to say the training partner is doing something right is by understanding the cost structure of their program. Does this sound reasonable for their cost, or does it sound too greedy? So that has been the biggest learning for us.
Got it. Great. Thank you, Sharath. Prashant, my next question is for you. You meet the learner at the moment they either enroll or they just walk away. The Kenya study found that tuition fee is barely half the story. Transport, tools, materials, certifications can nearly double the true cost. Is that also the case in India? When a learner walks away from your admission desk, how often is it really the price? And how often is it the shape of the money, the timing, the co borrower, the paperwork, the fear of the debt itself? And what would financing the whole cost of attendance and not just the invoice do to your enrollments?
Yeah, well, thank you, Sakshi, for having me here, and very interesting and important question. In my experience, Sakshi, learners do not walk away because they don't value the education or the training or the skills. They actually walk away because they cannot bridge the gap between the employability, the aspiration, affordability, and the outcome. That's the whole idea. In India, and I think across the world, tuition is barely, certainly a small part of the cost. And I'm using the word small, but it is often the biggest barrier, right? Because there are other costs associated, which are definitely not getting funded or financing. The real challenge is the total cost of becoming employable, just not tuition, just not the skilling part. Let me give you an example. A young person from, let's say, a rural district in India willing to enroll in a healthcare program or a technical training program, which can help him get an international job. But beyond the tuition, they have to pay for transportation, accommodation to the new city where they relocate, the uniform, the tools, examination fees, certification charges, digital services, internet access, a lot of other things. And often the income that they forego because they cannot work while getting the training. That is also a cost of the opportunity that they are trying to avail. For candidates preparing for international careers, there are additional costs like language training, licensing, visa, passport, and stuff like that, medical examination and travel. When we look at the complete journey, the actual investment required can be actually twice or thrice the course fee. Yeah. Um, Equally important is the shape of financing. Many learners don't tell us that the course is too expensive, or they don't say that I can't afford this money. They just say, hello, the paperwork is too complicated, or I don't have a person to guarantee the loan. I'm afraid of taking a debt because without knowing whether I'll get a job or not. That's an uncertainty that they are not willing to sign the whatever. So the actual issue is just not affordability, it's the confidence and cash flow. That is why I believe that we should move beyond financing education to financing employment pathways once we create that model. Financing should cover the entire learner journey from counseling to training to certification, placement support, and wherever required, even the mobility cost. More importantly, repayment mechanisms should be aligned with employment outcomes. As Sharath rightly said, I mean, you can't have a 3.5, 4 lakh rupee course for a 25,000 rupee job. More
Yeah.
importantly, the repayment mechanism should also be, how I pay should be linked to my salary. If learners know that they began repayment only after securing a stable job or reaching a certain income level, their willingness
Hmm.
to invest in themselves increases. Right? I mean, it will definitely increase. In our experience, when learners have confidence in three things: quality of training provider, a credible employer associated and pathway, and financing designed around the realities rather than the lender's convenience, enrollment would improve, completion rates improve, and employment outcomes will improve. Ultimately, learners are not buying a course, Sakshi, I always say this. They are actually investing in a better future, and our financing system should be designed to support the entire journey and not just pay for the training.
Absolutely, Prashant. Can't agree more. Prashant, this brings me to my next question on placement records. Every lender in this room prices one thing above all, whether your graduate gets a job and is still in it a few months later. When that fails, the lender takes the loss and puts it straight back to the interest rate into your next student when they have to pay their loan. So, how do we redesign this so credit risk sits across all of us, the training institutes, employers, governments, lenders, instead of entirely sitting on the lender?
Yeah. So I believe the actual and the fundamental question that we need to ask is who should bear the risk of employability? Who's
Yeah.
responsible? Today, in most of the scenarios, the learner carries most of the risk. If they don't get a job, they still own the loan. they have to repay back. The lender carries the financial risk because they increase interest rates, as you rightly said. Training providers get paid once the student enrolls and possibly are walking away with that money and not be responsible for the outcome. Employers often enter only at the end of the process, once the placement has happened. And if training has been bad, then they are not even taking that student. The model is neither fair, neither sustainable. If we truly believe in the outcome-based education, Sakshi, then the risk should be shared by everyone who benefits from the successful employment. Training providers should be willing to put their part of their fee at risk based on measurable outcomes, such as completion, certification, placement, or retention. This creates a strong incentive to focus not just on teaching, but on employability, the actual outcome. Employers also have a critical role. If they are facing talent shortages, they cannot commit to hiring graduates to meet, agreed competency standards. They should actually get in the beginning of the whole process, help in curriculum design and finance the whole thing, possibly help with tools and stuff like that. And there they will be sure that, okay, this candidate is good for me. The government should act as catalyst partners, because by providing first law guarantees, to the loans being provided, to helping the financing companies, they can actually be a cushion that the financing companies are always looking for. Interest subsidies could be offered by government on the outcome-based incentives for priority sectors could be offered. Financial institutions in turn then can design products where repayments are linked to employment or income rather than fixed dates immediately after course completion. When all the four stakeholders, the training provider, employer, government, and lender, share responsibility for outcomes, we create an actual healthier financing ecosystem. In global mobility, Sakshi, we already see these elements of this model. Employers know that they need skilled workers. Training providers prepare training for international standards. Governments facilitate mobility through policy, financial institutions. I think a similar ecosystem can be made for local. And also, global mobility is still yet to be explored in the real way. The real innovation, Sakshi, is not a new product. It's actually a new partnership model where every stakeholder has both responsibility and accountability for the learner's success. Because at the end of the day, we shouldn't be financing education in isolation. We should be financing successful employment.
Absolutely. And I think Sharath and a lot of other financial institutions in the room today will be very happy to know about the learnings that you are sharing today and the structure you have in mind and how this can clearly de-risk the portfolio, which currently sits entirely on the lenders. Any comments from you, Sharath?
Yes, Sakshi. So I definitely echo what Prashant has said. However, I just want to point out again, when we try to make multiple partners bear this risk, right? That's why the underwriting of the training partner becomes crucial. And here, what we have seen is these training partners, when they don't have a very strong balance sheet, they may be doing a great job, but their guarantee is not underwritable. So there are several scenarios where we had to walk away from those kind of deals. So other than that, yeah.
Sorry, we need more of Prashants in India and Kenya to be able to do this.
Yes, absolutely.
Thank you, Sharath. Thank you, Prashant.
Thank you.
This is an experience sharing from Indian market. And let me remind our audience that we at Opportunity International take pride in our partners and impact. And it's only because of these partners' willingness to share their learnings. We can conduct sessions like these. More coming up from Rebecca. Stay tuned and keep posting your questions in the Q&A section below. My colleague Divya will try to respond over to you on the chat or park the questions for our panelists till the end. I'll hand over to Rebecca now to introduce us to the panelists.
Thank you, Sakshi. Thank you, Sharath and Prashant. We are really delighted. We have talked about the risk, the underwriting of the institutions, and we all agree that these risks should be shared between the employer, the training institutions, and also the financial institutions. So we would like to hear from our financial institutions in Kenya. And today we are really privileged to have Janet Kuteli from Fortune Credit Kenya. And we also have Aquila Zomondi from Higher Education Loans Board of Kenya. So we are going to begin with Janet, where I'm going to ask you a question. My question, Janet, to you will be, Opportunity International Research found out that 78% of Kenyan TVET institutions are profitable, with steady enrollment and predictable fee revenue, and that fewer than 21% have ever taken a formal loan. In any other industry, a profitable business with recurring revenue is a borrower you would compete for. So take us inside the credit committee and tell us honestly, what actually stops the loan? Is it the collateral policy, the absence of the sector knowledge, the risk weighting, or is it plainly that nobody targets depend on it? Would like to hear from you, Janet.
Thank you, Rebecca, and that is a good question. I would like to clarify that not all profitable organizations also qualify for credit. I'd like to qualify my statement, maybe just looking at the framework for lending for all institutions, that most of the time you're looking at 5 C's of lending or maybe 6 for others. And one of the examples where a profitable organization cannot be able to qualify for credit is that if you have a poor credit reference. We have this person or this entity that is profitable, but they are poor at meeting their obligations. So they just decide not to meet the obligation. So that will be one of the examples why that particular institution cannot be able to get the loan. But in context of our discussion today, you realize that as a country, TVET agenda is an underdeveloped asset class. And therefore, most financial institutions have decades of experience in lending to the transport sector, manufacturing, agriculture, and etc. Now, when it comes to that part, it means that we want to look at TVETs just the same way and be able to look at a trader. The first question was, is collateral part of it? And the answer is yes. We see that most of them have been, most models have been structured against traditional collateral. What have we been able to do in Fortune Credit is to be able to think outside the box and be able to look at what are these non-traditional collateral that you can be able to use to make sure that the students that you are handling in terms of the school fee loan or the institutions that you are handling can be able to still access credit when they have the ability to repay, because that is one of the C's, the capacity to be able to repay. So we'll not tell you no in our credit committee. You have the ability to repay, and the only thing you're lacking will be collateral, but we want to look at the substitution part. Secondly, I'll be able to look at the scoring methodology that we've been able to use. It means that if you have scarce knowledge on a particular industry, for example, the TVET space, that will be substituted by a big no, or now you ask for collateral to be able to substitute for the lack of knowledge. Now, when it comes to the scoring conversation, data in this particular era is key. And I want to compliment what the team from India has actually spoken about. How are you looking at it, the ecosystem conversation? That if I was able to know that this particular TVET institution has a pipeline of this number of students and then be able to finish their course, then I have another employer on this side who is guaranteeing placement, and maybe we don't pick it at 100% because of different dynamics that will be able to change that, then it's easy for us to have a tripartite agreement between a student, the TVET institution, and the employer. Has it happened in Kenya? The answer is yes. In the aviation space, that pilots, their cost of training is high. And we have banks who are actually underwriting those loans where the pilots, when they start, when they start working, then the airlines will be able to pay the organization. So why is it that that cannot be able to happen in TVET? And yet that is the majority of the institutions that are actually taking our young men and women. So the other part that will actually make that particular institution say no will be, we've spoken about the credit history, we've talked about the capacity to pay. You could be willing to support a student or a particular institution, but they don't have the capability to pay, so you'll say no. On the collateral, you've said that you need to think out of the box. From the statistics, we are saying that 78% are profitable. So why is it that they cannot be able to get loans from banks? It's because of the nature of their cash flows. if we were able to only work on the repayment ability of a particular client that is actually runs hand in hand with the cash conversion cycle, that will make sense. Let me give an example today. If I have a parent who was a student in any TVET institution, and that person is a border rider, and they get their money on a daily basis or weekly, or maybe they're doing deliveries and they're paid once monthly, it will only make sense to be able to call the repayments schedules to coincide with the cash conversion cycle. If you treat any education institution like a trader or a manufacturer, then that is the time where you create a bad loan from the onset. I think I rest my case at that particular time and saying that, yes, that is a good avenue for financial institutions to be able to lend to. But because of lack of information, or at times, are we too lazy to be able to think out of the box and come up with other scoring methodologies and be on the ground and co-create a particular product with the TVET together with either the students or the parents who are paying the school fees? That will make a lot of sense. We work in disconnect, that what we discuss on the boardroom is totally different from what is happening on the ground. So the product fit will be the issue, not because the TVETs are risky. The only part is that we have information gap, and because we don't have the real information, then we also have a wrong product fit for the market. Over to you, Rebecca.
Thank you, Janet. We really all allude to what you're saying, especially the cash flow. The cash flow really came out as a key highlight from our market research. So I have a second question for you, Janet. I would like to share with you what we've learned from India and what will be your response to this scenario. In India, the thing that unlocked this market was not clever underwriting. It was a package of technical assistance from Opportunity International, subsidized by pilot capital from NCDC and government guarantee. And the moment it exited, 12 NBFCs registered and the lending base doubled. So 2 questions for you. First, does Kenya have an equivalent? And if a partial guarantee or first loss facility landed on your desk today or tomorrow, would you actually build on this book? Or would you have another reason not to? Back to you, Janet.
Thank you, Rebecca. When you look at Kenya, we have made significant steps towards establishing credit guarantees as a country. The government established a credit guarantee scheme in partnership with some few financial institutions so that they can be able to increase the uptake of loans for small business owners who don't have sufficient collateral. Over and above that, we also have development financial institutions like IFC, African Development Bank. We have some of the institutions like Greenmarks coming into play, African Guarantee Fund, that have also been able to support the guarantee and the risk-sharing solution for the financial sector as a whole. What have we missed comparing to the India solution is the tailor-made technical assistant that will actually be able to handle the skills training sector that we are talking about today. Then when you look at the pilot space, that we don't have that subsidized, or can I be able to talk about subsidized and at the same time patient capital that can be able to use it on the pilot for financing the particular TVET category that we are talking about today. So what will happen is for you to be able to go to any board and present to them and tell them there is this particular niche, I have this data, therefore I'm going to lend to it, that will not be able to apply. So the missing piece is the technical assistance that is actually tailor-made for this particular product. And if you can be able to have subsidized capital. On the next question, if I got a guarantee, first loss guarantee on my table tomorrow, will that be able to increase my portfolio as far as the TVET sector is concerned, or the edu finance? The answer is partially yes. And why am I saying partially? A guarantee in itself will be able to grow volumes, but not necessarily good volumes. Because what you're looking at is sustainability. And I think that if it was paired with a technical assistance in terms of how can you be able to co-create that particular product with the TVET institutions, and you have another organization that is actually supporting, for example, Opportunity International, that will also, it will make a lot of sense. But to make it better, if that was actually combined with the substrate capital, it will actually make me to go to my board today and say, I want to open a unit that will only handle TVETs, and therefore these are the targets that we actually want to run with. Otherwise, what will happen if we remain with things as they are, you'll be able to have a handful results that probably will be equated to a CSR conversation, but not a scalable loan book. Thank you, and over to you, Rebecca.
Thank you. Thank you very much, Janet. We all agree that actually technical assistance is really key in terms of co-creating products that speak the market, and also subsidized capital. And later on, we'll come to learn what else that this technical assistance from Opportunity International can be able to provide to us. So still from the Kenyan market, we have Mr. Aquila Omondi. He is from Higher Education Laws Board, Kenya. And I would like to ask you a question, Aquila. So my question goes, HELP currently funds students in both public and private universities through undergraduate and postgraduate loan products, and extends similar support to public TVET colleges under the Ministry of Education through dedicated TVET loans. Given that the prevailing justification for not extending this scope to the private TVET colleges remain the inadequacy of available resources, what consideration would guide the enlistment of these institutions, which are eligible for funding from the pool of nearly 3,000 private colleges and TVET operating across Kenya, should additional resources become available? This question comes to you, Aquila.
Okay, thank you. To begin, HELP is the leading finance. Thank you. To begin, HELP is the leading finance of higher education in Kenya. We've been in the business for over 30 years, and we've been funding students enrolled in university and also TVET colleges. Yes, for the institutions in the private sector, those are private TVET, they represent a very big potential. And where there's potential, there's definitely a risk. For us, considering this pool of great number of almost 3,000 students, there are basic considerations that we'll have to factor in when we extend our funding to them. The first one will be the regulatory compliance. We've seen intensified regulatory framework in terms of licensing and also accreditation of the courses. You don't want to fund a student who will not be able to complete the course or terminates halfway. So the regulatory compliance translates to the continuity of funding, because what you are doing is trying to protect the sustainability of the fund that we manage, because it is a revolving fund. We also source our funds from the government, from development partners, and also from private sector players, dispersed to the student, and then to ensure that that fund is sustainable, that it is a revolving fund. We look at the industrial linkages. Institutions that have strong industrial linkages translate to quality graduates, and also the students are able also to liaise with the industry players to ensure that there is also a transition to the employment pathway. There are also enrollment trends. And apart from us who finance the students, those who may wish to also invest in terms of infrastructure development, this will be key, considering that enrollment definitely translates to the health. Low enrollments will definitely mean that the cash flow will be very low, and this enrollment trend should be able to be predictable in terms of the season. Most of the TVET institutions have 3 intakes, that's January, May, and September, with September being the key intake. So even the repayment schedules for the investment in the infrastructure development will now have a flexible or a structured repayment schedules depending on the seasons. When we come to course completion rates, which is very key, just also to ensure the sustainability of this revolving fund, we should be able to monitor from enrollment to where the student exit is the completion rates enough to be able to inject funds, also or fund students to that particular college to ensure that they're able to complete and able to repay. We look on the specialization. The institutions which have specialized in various fields, and we've realized the institutions which have specialized in specific areas tend to have lower market risk in terms of the graduates that they are able to produce, and also on the way they repay, and also on the practical skills that they acquire, because even the kind of lectures or the kind of trainers they employ are of also high quality. When we check on the cost of program, that translates to the affordability. Are the students able to pay? And also for the income in terms of the parents, are they able to pay? Because now this one will also translate to those who may want to invest directly, probably on co-borrowing, where our parents borrows on the behalf of the student. If the cost of the program is higher, this one will also translate to the repayment capability of this particular household. And then also on the income diversification, is the institution relying solely on tuition collection, so that this one also reduces rate of default? And for also diversification, meaning that they also have production units where students are also able to gain the practical skills that will also help them transition to the employment area. Then finally, of key interest to us is the financial management systems, because the funds that we disburse to the institutions, we engage the institutions directly on the behalf of students. Students apply, and then we send the money, or we digest the fund to the institution. If the institutions are not in a position to account for these fundings, this will directly impact the sustainability of the funding when now there will be future disputes when it comes to repayment. That's all I have for now.
Thank you. Thank you very much, Aquilas. This is really conversant, and we can connect with what we heard from our colleagues from India. You can tell we talk about affordability. You're talking about the specialization of the course, completion rate. So all these cuts across, and this is what also our research has demonstrated. So Aquilas, I have the last question, a brief question also that regards the government of Kenya and what it has taken as a direction from now in regards to TVET. So the government of Kenya has allocated 56 billion Kenya shillings, which is equivalent to 435 USD million, to help for students as loans to be disbursed across both universities and TVET colleges. How is this allocation framework structured, and what methodology is applied in determining the loan amount allocated per student? Would like to know that.
Okay, thank you. For over 30 years, HELP has relied on the mean testing instrument, which is the key assessment and allocation framework for student financing. This also represents the strength that we have as an institution, because we are able to evaluate the student's level of need. So the mean testing instrument determines the student level of financial need by assessing the parent's social and economic background. So it is the parent that we assess that will translate what we'll give to the student. More specifically, it evaluates household ability to contribute toward the cost of higher education training. The current model requires contribution in 3 tranches. One from the household, the next one is from the government scholarship, and also from the student loan. So why does this matter? You are well aware that the Kenyan's economy is largely informal. So getting direct income data is usually not available or unreliable, and sometimes unverifiable. So the mean testing instrument resolves this by ensuring that we have structured data which is also proxy driven for household income status, giving us a more reliable measure even where formal income record doesn't exist. So even with the current partners that we have from private sector, from also the government in terms of county government, this is the tool that we've deployed just to ensure that we're able to also measure the level of assistance. And now within this particular framework, we assess the level only from the most needy to the less needy. For the less needy, represent a family which is able, and also for the most needy, represent a family which require more support from the government. So our mean test instrument doesn't rely on self-declared data. We have signed data sharing agreements with various partners, that's the public institutions, just to ensure that the data that the student feed in the application tool is verifiable, and we are able to validate for just to eventually place that student to the level or give them a score that will translate to the amount that we provide to them. So this means instruments is consistent, verifiable, and also defendable. It has been subjected to public participation through the various stakeholders, that's the government in form of the legislative wing. We have the public in form of students, university, and all the interested parties. So it has been subjected to public or participation just to ensure that the outcomes are acceptable to one. Of key importance is that we don't build it in isolation. This mean testing instruments draws an internationally recognized poverty assessment approaches while remaining tailored specifically to Kenya's higher education, training, and financing environment, just to ensure that it is objective, consistent, and fiscally responsible, to ensure that we direct public financing to the students who need it most in a manner that is fair, predictable, and sustainable.
Thank you. Thank you very much. This is very informative. We really understand the structure that the government of Kenya has taken, and we are very happy that our market research finding really fits into the model that you're working with. So back to my colleague, Sakshi. Thank you for this session.
Thanks, Rebecca, and thank you to all our panelists. We are now moving to our next section of the webinar, and it's called a rapid fire round. Our audience and panelists will play this together. We will flash a question on your screen. You have two options to choose from, fund or fold. Remember that every market is very different from each other, so there's no right or wrong answer. You can see the responses in the chat, hopefully. I'll request our colleagues to flash the question. Brian, right, can we have the question? Am I not able to see? Are our panelists able to see the questions on your screens yet? Not
No.
yet.
No.
Okay. Brian?
I think it's posted in Q&A, Sakshi. I see that.
In Q&A? Okay. No, these are maybe in the meantime,
Okay.
we'll take the question from the audience, and yeah, but meantime, my team will fix the rapid fire. We have a question for you, Sharath. What portfolio size, at what yield, at what loss rate makes skills lending a business rather than a pilot?
Okay, so at least for us, it's a $1 million USD portfolio at an average yield of 28%, and at a loss rate of 2% makes it viable for us to survive.
Great. I hope Jasmine has it answered. I can also take the next question, which is for Sanjeeva. If placement record predicts repayment better than a credit score, then outcome data is the best collateral in this market. Who pays to build it? Has anyone in India done yet? Mr. Sanjeeva Singh, would you like to take
Yeah,
this question?
Yeah. So see, if we talk about legally, so outcome data may not be legal collateral. It is an underwriting asset. And in India, we have already tried with certain rating agencies, and still we are improving that. And in India, NSTC has already done that, and NSTC is funding for that. So originally, we have a rating agency wherein we were taking only static input data like infrastructure and quality. Now we are moving with additional dynamic input like attendance, engagement, dropouts, and also market intelligence, like number of job available, salaries, number of candidates. So all those things we are just combining in one rating system. It is coming out, and NSTC is funding that in India.
We have one more question, and I think I can direct this to Prashant because he touched upon this when we asked a question. What partnerships in Kenya or India have you seen work well between education providers, financial institutions, and employers?
Yeah, I think we are experimenting. There is no evolved product as of now, but we are experimenting with a project where we from India have taken ownership. And this is actually a very interesting project because we've actually identified nurses in South Africa and nurses in Kenya. Kenyan nurses are now being trained for German language training to go to Germany, and South African nurses are being trained to go to USA. And the entire cost of financing is borne by a company called Chanson International, again, into the income share agreement kind of a model. If this works, it is a partnership where we have also taken a share of risk. If the nurses do not get trained well and do not migrate, we'll go and refund back. So there are experiments that are happening, but as I mentioned, the ecosystem needs to come together and share the risk. There is no one product that I know or a partnership that I know as of now, which is a success. I think all are going to be experimenting for some time before we evolve into a product which can be scaled.
Thanks, Prashant. Janet, would you also like to take this question if you have any evidence from Kenyan market?
In the education space, not yet.
Not yet. Right. Okay. This is one thing that we are trying to test next in India. We're working on it already. Hopefully, when we all meet next time, I will have more updates for you. Great. So these are the questions so far. Audience, if you're still tuned, please don't forget to use the Q&A. May I check with my team now if you're ready with the poll? Maybe I can do a lighting finish Q&A with our panelists in the meantime. Sharath, bureau score or placement record? You get one. Which one would you pick?
Bureau score.
Janet, government guarantee or cheaper capital? You get one. Which one would you pick?
Repeat the question.
Yes, I can. So a government credit guarantee or cheaper capital? You get to choose one. Which one would you pick?
Triple capital.
Cheaper capital. Okay. Sanjeeva, sir, if you can complete this sentence for me, skill financing will scale the day when?
Yeah, when verified employment outcome become trusted underlying asset for lenders.
Wow, that's deep. Okay. May I also ask the same question to help? Sir, skill financing will scale the day when?
When you are able to bring all sector players, including the private sector.
That's again very deep, and there is still a long way to reach. But we are on the right track. Okay, team, can we have the poll now? Our audience is waiting. Our panelists are waiting. I think we can just take it as is, and I let the panelists choose between the options that we have, fund or fold. And I can give you the scenarios. There's a welding student, 19-year-old, no credit history, mother sells vegetables, course fee 700 USD. The course itself places 71% of its graduate. Would you fund or fold?
Would you be able to say what is the kind of compensation the person gets?
Sir, these are the facts you have.
Okay, so fund.
Fund, okay.
It's a fund.
Fund for you. Everybody unanimously says fund. Great, okay. That's a good scenario to have. My next question. A private TVET college. And I want Janet to answer this one. Profitable, 6 years in running, full enrollment, no title deed, no collateral of any kind. Wants 3 million shillings, 23,000 USD roughly, for missionary. Fund or fold?
Fund.
No collateral. Fund. Amazing. Everyone's getting a loan today. My next question. A learner enrolling in a 12-week AI and data course, fee is roughly $4,500. No placement guarantee, but the institute has a 90% replacement history, and the sector is hiring. Fund or fold?
Fund.
Sharath is funding. I think we should fund the student. Sharath, what gives you the confidence that we should fund?
So compared to the last question in your last question, there was the success rate of 70%, right? So that's very
Yes.
risky for a lender. Whereas here, the percentage of outcomes is very high, so it's less risky.
But just a
Okay.
debate, $4,500 is very high for a course of AI or whatever. It's very high. It's not the market standard. So we need to do a little more investigation as to what certification it's leading to.
Prashant, maybe the student, it includes visa and flights and everything. no?
Yes, then
The
it is
student's
definitely
going
a
to
fund.
Germany.
Then it is definitely a fund.
An upkeep, right?
You wanted the tuition fee and the ancillary costs also
Yeah,
to be
but
included, so we
you see
included it.
the problem and the way I see the things having is we are saying training providers. We actually have to say employment providers in my case. We also have to relook at the whole model. Once you go and say the training provider, even the training provider plus the company and everybody just focuses on providing the training and finishing. But when we come back like 2Coms, we never say we are training partners. We are employment providers. So we will help you with the job. That's the idea. When that comes, everything gets added. Yeah.
Got it. So it's training plus employment. Okay, I'll move on to my next and the last question. A training institute that guarantees placement and refunds the fee if the student is not placed. It wants working capital to enroll its next cohort. Fund or fold?
Fund if the guy has deep linkages in the industry where it's going to help them with the job. Very important, the training company or the employment company has employment linkages sorted out even before he or she launches or they launch their next cohort.
Does anyone
It's a,
think otherwise?
it's a fold from my side.
It's a fold from your side.
Yeah.
And so
I
please
can
please
explain.
elaborate.
See,
Mhm.
particularly for institutions, they are getting advance in fee and they are having good number of placement and still that company is asking working capital. So normally whenever you are getting an advance in fee, there is no requirement of working capital. There may be unplanned expansion of the company that may lead to a larger risk and that's why I will go for fold.
That's a banker talking. Thank you so much, everybody, for being a sport and sharing your opinions with us. We can now move on to the concluding slides. If we can have the slides back. And over to you, Rebecca.
Thank you. Thank you very much. That was a rapid fire, even if our pool wasn't on the screen. Thank you very much for really activating those questions, and the responses are really, on point. So as we conclude, maybe Brian, the slide. As we conclude this session, we now move to the synthesis, what all this evidence means for financial institutions. This is where we translate the findings into opportunity, and we'd like now to agree together what are our next step. So this is where we talk about financial institutions. They are required to look at financing TVET as a full ecosystem. The opportunity is not just student loan, it is a full ecosystem with 4 segments that are ready for financing. We are talking about the students, we are talking about institutions, employer-linked finance, and digital transactional banking. We have seen employers themselves say they are willing to help carry the risk. So this proves that this is a multi-segment market with multiple entry points, and that is why we're here. As we move to the next slide, we talk about adapting the financing and not the demand. So here we run into the 5 shifts. These shifts are the ones that are going to help unlock this market. And we are talking about 5 aspects: flexible repayment, non-collateral lending, longer tenures, cash flow-based assessment, and employer-linked models. So here we agree together today that institutions that lead in redesigning their product in this direction, they're going to take the first mover advantage. So we move to our takeaway for this session. So if there is one message today that we are going to take with all of us, the barrier is not the risk, it is the product design. The market is viable, the borrowers are motivated, institutions are profitable, the product simply needs to fit the reality how people earn. So let's look what happens next. Opportunity International has been offering technical assistance, which really came out soundly in this call, that it has been so much instrumental in building such co-creation of products. And this is where we offer what we do in this regard. We offer market research, we offer product design, staff training, funding linkages, market making, business intelligence, and even credit tools. So here, if you're interested in this building a TVET product, you can register in the chat. We will be readily available to interact with you. So as we conclude today, we look ahead, and the question we are talking about is not access to education. It's about outcomes, what it takes to get learners from training to livelihood. So the ultimate financing is the lever that will determine whether skills truly translate into livelihood, and that is the work that is ahead of us. So thank you very much, and I welcome my colleague Sakshi.
Thank you, Rebecca, for concluding it so well for us. Someone has rightly said that knowledge comes from learning and wisdom comes from experience. Thank you so much to the power-packed panelists for sharing your wisdom and knowledge with us. I would now like to call Jane to say her word of thanks to panelists and our audience for joining us. Jane, over to you.
Okay. Looking for my buttons to, yep, yeah, it is. All right, so thank you very much. Being a sector that is not very, very active in sub-Saharan Africa, I actually enjoyed listening to the Kenya team coming up with all those kind of solutions that are already on the ground, the kind of institutions that are up and about regarding how they can de-risk part of that portfolio. So I am seeing a position where we're going to be growing the TVET in Kenya, particularly because we had panelists who are from Kenya. Kenya, thank you so much. The team from Kenya, thank you so much for sharing what is happening and what we can do in Kenya. The India team, thank you so much for sharing what did not work and what is actually working. I am hoping that the people who are on the call today have been able to listen to both sides and seeing the possibilities that we have. I'm also hoping that they have seen what went wrong and they can avoid those pitfalls. I actually liked the questions that were coming up on the chat and the rapid fire that Sakshi brought on, and I was keenly listening to why this and why that. And I was hoping that I wish that everybody on the call was able to engage. Thank you so much, our facilitators, for this. Thank you so much, our panelists. Personally, I've learned a lot from both sides. Facilitators have said, that is Rebecca and Sakshi. Opportunity International is here to support. So whatever financial institutions are thinking about this in Kenya or any other part of the world that we work in, we are here to support you with technical assistance. We are here to support you with the ecosystem. You've had the practical bit that the India team has come up with. So we can tap on that knowledge as we continue going to the next element of implementation, especially in the Kenya space. So thank you so much for sharing your knowledge and the practical approach to this. For everybody who managed to log in, thank you so much for coming in and asking those questions. For the colleagues from Opportunity International, thank you for supporting the team. Thank you for being around. And I'm hoping that with this, we're able to take the learnings to the other markets that we are in. We also have some of the support members on the team. Thank you so much for ensuring that we coordinate properly on this. With that, I am wishing all of us a good morning, good afternoon, good evening, wherever you logged in from. Thank you very much.
Thank you, everyone. Signing off.
Thank you.